So meanwhile, certain things which we want our audience to understand well, this session is purely educational, and these are individual views. The guest and I, as a host, are not responsible for anything which you take decision on. This is purely educational. Take this as a starting point. By no means any kind of buy, sell, or hold recommendation on any business we would be discussing during the course. It would be so as to illustrate the concept, or maybe we try to avoid naming companies. But again, if it happens, so that should not be construed as a buy, sell recommendation. And those who are joining for the first time, we had a session with Sahil a few months ago, and that is also available on my YouTube. So after this session, you guys can surely revisit that session also, wherein we focused more around investing framework and portfolio construction. So Sahil basically is a very passionate investor, and by education he holds a dual degree in computer science and engineering from a very renowned institute, IIT Madras, and he is currently working as a senior software engineer at Google for over 6+ years. So anything, Sahil, which I missed on your introduction, I would request you to add, and then we can surely like start with the session and opening note come monologue around the topic. Then we move on to questions, and after that we will be opening the floor for the audience to ask questions as well. But we would request, make your questions smart. Do not directly ask any business name, buy sell thing. We won't be like answering those questions. Over to you, Sai.
Yeah, thanks, Prince Bhai. So, Prince Bhai had asked me a while back what topic I want to speak on. Um, I think the most important thing for people to understand is, I think personally, it is not about how to generate ideas, it is about how to screen ideas and to figure out what companies are even worth going deep into and what companies are not worth going deep into. I think yeah, probably is the most important thing, primarily because today's day and age, the way it is ki there's an information overload. We have all kinds of people talking about all kinds of companies all around us. You have fund managers. There are these YouTube channels like PMS AIF World, PMS Bazaar. Um, you have forums like Twitter, you have forums like Value Picker. So I think then you have Screener where you can go and create your own screens. I think the difficult part is not the names. The difficult part is knowing what do you want to own. I think that is a much harder problem, but in a way it's simpler also. So the question is, how do you screen the stocks that the world throws at you? Iskandar, I think the very first starting point for everyone has to be to realize that there is no one answer or there is no one solution that works for everybody. It's a function of what appeals to you as an investor. Who are you as an investor? That really decides on what kind of stocks you will screen. So, this is why it is very difficult to blindly follow someone else's conviction because you don't know why they have bought that stock, or what were they thinking, what is their thesis, what is their holding period, what is their percentage allocation. You really don't know any of those things. Now imagine that somebody who has, let's take an example of one company. They make shunt resistors, and in 2019-20 period it was down by 85% from the peak, right? Now, if you are a kind of an investor who has 50 to 100 positions, you might have, 4 5% in your largest position. So even if this company is your largest holding at 5%, even if it is down 85%, just one company, it won't hurt your portfolio that much because you lose 2 3%, but the rest of the companies, if you are a good investor, they would have done okay. And so at a portfolio level, it will not hurt you. Whereas if you're a concentrated investor, if you have only 10 positions, right, then this position can easily be 15%. Now, on that 15%, if you lose 85%, that is going to be a much larger hit, right? It hits you by 12, 13% at a portfolio level. It sets you back by maybe a year or at least by 8 months or so. So what I'm trying to point out is, every investor is unique, literally, because of the fact that, their own life experiences, what appeals to them, how much risk they want to take, how they want to deal with that risk, all of those factors. And because of that, it is irrational to clone someone's conviction. Not only is it what do you say, a disclaimer that people give, which is do your own research. It is the rational thing to do your own research. There is no other way because you really don't know what the other person is doing with that stock. You have a name, you know that X is buying Y, but you don't know why for what duration of time, right? So first step is to know yourself. Once you know yourself, you know what kind of a style you have, what kind of return expectations you have from the market, what are you willing to give to get those returns. If let's say my return expectation is 25%, but I'm willing to give 2 hours a week, that is, in my understanding, not going to be enough, right? That's an irrational expectation or a mismatched expectation. If I want 25% compounded over a long period of time, in my opinion, we should be willing to give at least 16 hours in a week, which is like maybe 2 3 hours a day, roughly. So my point is like basically we should know ourselves first, how much are we willing to give. The question is not, I mean, the first question shouldn't be how much do we want to take. The first question should be how much are we willing to give. Then the next question is what is our style in terms of our ability to take pain, right? Are we willing to sit through drawdowns in an individual position? How much drawdown can we sit through? By the way, there is this really good name for this called Uncle Point. And I want everybody to search, maybe Google search for it called Uncle Point. Uncle Point is basically the point of a drawdown at which, you basically, in a way, lose hope or you become sort of the size of the pain is large enough that it is hard for you to bear as a person. And everybody has a different Uncle Point. Imagine that your portfolio goes down by 30%. Is that going to make you lose sleep? Then that is your uncle point. For somebody else, if that number is 50%, then that is their uncle point. Very rare investors, very, very rare investors, and I am not in that list, but somebody might be willing to go down by 70%, right? I'm not willing to go down by 70%. That is too really, where I was is that the first step, of course, always is for the investor to know themselves. Because only when you know yourself can you know what kind of companies or stocks do you want to screen. There are people who are malleable enough that they can own anything. Then there are people who would define a very tight circle of competence and only operate inside it. But my sort of reasoning here is that as a young investor, I don't think it makes too much sense to have rigid circles of competence, but rather to expand those circles of competence through hard work. Right? To begin with, a young investor should have ideally no circle of competence. But that does not mean that we cannot learn and thus expand our circles of competence over time, right? It's not something that happens in it can't be speeded. It takes time and experience to expand those circles of competence. So, coming to like how to screen stocks, I think I can primarily talk about how I screen stocks. This is important to me because at least where I am is ki there are always too many companies and not enough time to work on them, which effectively means I have to screen them and figure out where will I even go deeper, right? Now, the first thing I want to point out is for me personally, it is like a spectrum. Think of it like a power law where most companies will get dropped off soon, right? They will get dropped off after maybe 15 minutes or 30 minutes of quick read. And then there will be a smaller number of companies where I might read them for, 2 hours, 10 hours, some number of hours, and then drop them off. Then there will be even fewer companies where I might go even deeper, maybe, 2 days, 5 days, 7 days, and then drop them off. And then the last type will be the companies where I might have, read them for a very large amount of time and then dropped them off because of some reason. The important thing is it's like a continuum or a spectrum. of, like basically it's a continuous process of screening. Screening is not just a one-time thing. You're just continuously thinking that does it make sense for me to track this company? Because there are 5,000 listed companies. Any one person realistically can only track maybe, 20 to 30 companies at a time. So that means you're continuously, thinking of evolution. You're thinking of key, what are the new companies I can track, and equivalently, what companies should I stop tracking also? Now, the point is for me personally, how do I decide, which company to track, which company to not track? I think that the thing that I try to follow is that there have to be good tailwinds for the company. I should have good visibility of the next, 2, 3 year kind of earning. I should have good visibility that the company can compound its earnings at least 20-25% for the next 2, 3 years. The second thing is on quality. This is very important to me. Even if a company has very high order book, very high revenue growth, there are a lot of these EPC companies which have very high revenue growth and large order books. I would not get into it because the business model is fragile. It is not robust enough, meaning that in a downturn, all that order book can vanish into thin air, right? So, I mean, these EPC kind of companies, a lot of the PSU companies, PSBs, public sector banks, these are companies that I would not want to study or track or screen, right? I would not even want to track and study companies where there is no differentiation, meaning it's largely commoditized. I can give one example of a particular forging company where when I was talking to an investor, what I learned is that the kind of thing they make is so commoditized that there are at least 10 other companies in India who make the same thing, and there is no differentiation. They all make the same thing, and then they'll probably compete on price. That is not the kind of company I want to own personally. The reason being that those are the kind of things which are like a race to the bottom. It's very hard to predict which company will actually gain market share and grow. Compared to that, the kind of companies I do want to own are the ones which have some kind of competitive advantage, proven track record of execution, not just like some kind of hope or some kind of thesis, some kind of narrative, but actual numbers also, right? The numbers and narratives have to match for me to feel comfortable owning it. Because I feel like those are the kind of companies where the leap of faith is smaller. The probability of success is higher. So basically, we are looking for companies जहाँ पे की profit pools are very concentrated. For example, this shunt company I was talking about in the beginning, that company has 15% of global market share of these kind of shunts, right? 15% of global market share. That itself shows you the kind of dominance they have. This is the largest company in making these shunts. So a lot of times, people tell me that Indian companies are not innovative. But if you do enough due diligence, look deeply enough, you will find enough Indian companies which are global market leaders, not just Indian market leaders. Of course, goes without saying that these companies are like a total monopoly when it comes to the domestic market also. So my primary point is these are the kind of companies which are attractive to me, meaning whenever somebody tells me a name, I would quickly try to figure out what kind of entry barriers are there, what kind of competitive intensity is there, how much competition do they have, are they one among 50 companies doing the same thing? Number two, are they gaining market share or losing market share? Number three, what kind of stability of margins have they had, or have the margins been volatile? Those kind of questions. This is also why I have personally been unsuccessful in owning chemical companies because I've always thought that they were very B2B and industrial kind of companies, meaning that they will have a kind of a business cycle. And I have to be really on top of these, chemical spreads, what is China doing, external, extrinsic factors like that in order to track the probability of the success. Whereas with many other companies, I felt that it's not just a question of gaining market share, which itself is hard in chemicals because China is very dominant, but it's a question of the end market expanding very fast. For example, the company I talked about, the shunts company, they're the BMS segment, battery management system segment, because it goes into EV. That segment globally would be growing at some 20-25% at least, along with the EV market globally. Right, so the global market itself is growing 20-25%. Similarly, capacitor companies, film capacitor companies, Exactly same thesis. They're like these new age applications are themselves growing at some 20-25% globally. So even if they don't gain market share, it is good enough. The fact that they are dominant in that market and they are gaining market share is, additional thing on top. So I would basically, whenever somebody tells me a company, look for these characteristics: industry structure, tailwinds, ability to gain market share. These kind of things are there. Then I'm interested in the company. Otherwise, I'm happy to miss out and not make money. So a lot of these order book driven companies which keep getting sort of circulated, I'm not interested and I'm happy to miss out on them. So I guess that was my opening remarks, and Prince, we can take any questions now.
Great, Sahil. So, Sahil, the presently like the market situation, although like you believe in like specific companies, whatever the broader market situation is, but again, how you see the present market outlook and how you, I mean, is there any segregation you make on like if the market broader market atmosphere is not conducive, you come in cash or you are always invested? How you go about it?
Yeah, thanks for that question. Actually, that's a very important and pertinent question. I actually made a video just today on this exact topic. I think it is a very personal thing, very subjective kind of thing. I'm sure many investors take cash calls, and all the best to them. What I feel is that we always have enough opportunities in 5,000 listed companies, where there are bound to be some companies which have a combination of the three things I want, or the trifecta I want. That trifecta is: one, high growth; B, high profitability, which is basically profitability meaning high ROCE, which is proof of competitive advantage and moat. When I say high ROCE, I don't mean for 1 or 2 years. I mean a sustained, over many years having high ROCE, which is proof of the sustainable competitive advantages. And C, low valuation, right? I want all the three. Ideally, at every point, my portfolio PEG ratio should be less than zero point 0.5. That would be the ideal blue sky scenario for me. Because if my portfolio PEG ratio is less than zero point 0.5, effectively it means if the PE is 15, then the growth is 30. If the PE is 12, then the growth is 25, something like that, roughly, ideally. Then basically, even if the market crashes by 50%, my portfolio also crashes by 50%. The PEG ratio goes from, let's say, zero point 0.5 to 0.25, right? It becomes a screaming buy. From a buy, it becomes a screaming buy. And I'm happy to deploy more of my salary and, buy more of the companies that I own. So, I mean, I think the important thing is I need all the three. A, if the company does not have growth, then the problem is that any PE is too high. Because if you see the Indian market, we don't get valuation for high quality. High quality companies without growth quickly get derated. Even the likes of HUL have gotten derated because of a lack of growth. And similarly, you can see Castrol is the poster boy of high ROCE but low growth. Again, like abysmal valuation. Number two, high ROCE and high competitive advantage. That is important to have high predictability or probability of success. Meaning, basically, I don't just want some growth which is volatile, which can be there today and not there tomorrow, but I want growth which I can predict will sustain into the future. And profitably, of course, sustain into the future, not just burning capital kind of thing, but profitably making money, growing those profits. Number three, the valuation. The valuation is equally important. Imagine that I have a high ROCE, high growth company, but at a high valuation. That is also a recipe for disaster. Because in these kind of crashes, these kind of companies can derate. They can grow from 70 times earnings to 35 times earnings, right? And they may never re-rate after that, depending on how the economic environment and macro factors are. So I don't want to be, caught with these PEG ratio 2 companies, which are like basically overvalued. I don't want to own those companies. So at every point, I'm constantly thinking, are these companies deserving the valuation that they have, or are they overstretched? Right? And of course, the one key addendum to add here is that, even if a company is overvalued, overstretched, it does not mean that I will, not monitor it. For example, Saregama and this other shunts company, which is Shivalik Biometals, I know even if I sell them, I would obviously still monitor them, listen to their con calls because I want to be on top of it. Even if at some point I realize that my selling was wrong and that their growth is back, right? Whatever stagnation of the business was there in the last couple of years, that is not there in the future. Then I don't mind buying at a higher price or anything, as long as I have the margin of safety. So that is the short answer.
Agree, Sahil. But again, Sahil, like the combination of these 3 points, I mean, that's rare, right? Because high growth and high ROC companies, once discovered, are always richly valued, barring like Black Swan events. So that itself limits the sphere of companies. You agree on this, or like you have a different opinion? How you see this?
The way these things pan out is that most of the times market does not take recognition of these factors very quickly. People take time to get convinced. And our competitive advantage as investors lies in doing deeper research faster and reaching the correct conclusion faster. Right? It is basically if somebody takes 3 quarters to get convinced, I am convinced after my study in 1 month, then I get the alpha for it, right? And the way these things pan out is that a lot of these companies at low valuation, there will be a counter narrative. So effectively, I am having a variant perception to the company. For example, if you look at Angel One, uh, very recently as like February, March, it was at like 10 times earnings, 11 times earnings. Right. And at that point, everybody would have the counter narrative that it is broking, it is cyclical, it is this and that. But even from that point, it has appreciated some, 80, 90%. And before that, also, it has been a four bagger. And I mean, in the future, there is no visibility of a slowdown. Of course, the risk factors exist because of which one has to control the position size. You can't go all in, so to speak. But a lot of these companies will have a counter narrative also, and that is where the data and the research become the important thing. That basically, as investors, we have to have an independent opinion backed by data and not get carried away by narratives built by anybody. Right? This is not a profession where dogma works. It is not, you can't rely on everybody else's conviction or their words that, oh, 10 people said it is cyclical, so I will believe it is cyclical. You have to look at the data. If you look at the NSE FNO options, it has effectively grown year on year for the last 15 years, right? Then where is the cyclicality? There is no cyclicality. It is just a narrative which is there in people's minds because of some reasons. But basically, my point is that we can have a variant perception in companies where the market doesn't agree with us initially.
So one question in the comments, the person is asking your view on e-waste recycling industry, and especially the companies of the likes of eco recycling. Just in case any business view you have.
So, like, first thing I want to say is these are like very, very small companies, some of them. So, they are very volatile and like one should be very, very, very careful about these things. I mean, a company like EcoReco, they have almost no revenue and still they are trading at 300, 400 crore market cap, right? So, people were talking, in general, they are talking about euphoria. Certainly, in the micro cap space, there is euphoria. That is very much visible. It does not mean I will own no micro caps, but my barrier to ownership will go up. Meaning the company has to be even higher quality, even greater visibility of profitable growth for me to own it. Right? I will not own it randomly. I will not lower my barriers. So, with that said, I have studied eco-reco in this space. My understanding is that a lot of the policies that existed were not implemented efficiently, and these extended producer responsibility platforms have come up very recently, where the government is forcing all the stakeholders to come onto the same platform. So the government says that all the registered recyclers like EcoReco, and then there are much larger companies like Atero. So anybody who's tracking this space should check out Atero, which is a unlisted company, ATTERO, Atero. You can check out this unlisted company. You can Google for it. You can go to this website called Toffler, which has financials of unlisted private companies. You can check out for some 400 rupees. You can download the financials for Atero. So you can look at these companies and see how fast they are growing, right? But the thing that has to be understood is in these high growth kind of industries also, sometimes profit won't get made if there are no competitive advantages because the margins get competed away, right? If there are no barriers to entry. For example, if you look at these solar panel companies, right, which take cells and make panels, there are almost no margins there. That is because there is no competitive advantage. Everybody can do that, and so nobody makes money. Nobody makes margins. Everybody tries to become larger and larger to gain scale, economies of scale, and so on and so forth. And in that, they are able to sacrifice margins, not make good ROEs. And you can do the math on it, but basically, high growth and no ROE or low ROE results in no value creation for the investor. Only if return on equity ROE is greater than cost of capital and significantly greater, only then value gets created. So my point is one has to be very careful and do a deep study of it, especially because many of these are like this company they mentioned is probably at like 30 times sales or like some outrageous number like that.
Right side. So another thing, so basically we are there are so many talks when it comes to energy transition space. So you have any is it more of narrative or on ground you are seeing this is happening big time? So how you see the space as a whole?
So, I mean, see, one thing that has to be thought about in a first principles manner. What are we doing when we burn fossil fuels? We are taking the plants and the animals that have decomposed over a period of millennia, millions of years. Actually, millennia is like 1,000 years, but in this case, millions of years. And then we are immediately burning them to release all the energy stored in them in a very short period of time, because we have been burning millions of years worth of organic matter in a matter of seconds. Because of that, the carbon emissions have gone up very dramatically, right? All you have to do is basically watch out any documentary on this space, and you will be able to convince yourself. Even if you see things around you, if you don't do anything else, just see things around you, extreme weather events have gone up very dramatically. These recent kind of monster monsoons in Himachal, where everything got flooded, everything, a lot of loss of life and property, all of these extreme weather events are increasing throughout the world, not just here in India and Bharat. And because of that, it is very clear that human made um, climate change is a very big and real thing, which is why you will find world over that trillions of dollars are getting poured into this climate and energy transition, climate tech, transition tech kind of investments. So it is most certainly very real. What investors have to figure out is that what is a high probability way of playing these things. What at least I can find right now is that electric vehicles or EV is one of the best ways of playing it. Most of the research I have done deep into this has convinced me that the kind of narratives which people try to spin around emissions in mining, those are very flimsy narratives, because once you have mined the lithium, you can actually recycle it very very well. In fact, most of these companies that produce the cars also recycle the lithium, right? So that's not a big deal. The mining cost is paid once, but you can recycle it. It's a circular economy. Whereas with carbon emissions, that's obviously not the case. You have to keep burning things. The second most important thing is that incrementally, the quality of the electricity keeps getting far better over time, right? I mean, today it might be, let's say, 70% coal and 30% renewable, but this 70-30 will become 50-50 in a matter of, let's say, 20 years, and then it will become 70-30 in a matter of 40 years, right? Eventually, so we will go to 70-30. Because of that, these EVs have a much higher terminal value than ICE and any kind of fossil fuels. But I think the key thing which I think about as an investor is that how can I play these things? For that, I need the three things which I talked about: good margin of safety in valuation, high growth, and high ROCE or high competitive advantages. So yeah, there are companies like that, but I think most of them are in the EV space. I have not found very good companies in the solar space, which are having high competitive advantages. Most of them are very commoditized in nature. And as far as green hydrogen is concerned, to be honest, I haven't gone too deeply into it, so I don't know enough to make a good comment.
So Sahil, the PSU space has done quite well in last 2 3 years, and recently also the space as a whole is undergoing a good rally. So what's your view on that space, and going forward also, is it I mean, this fits the criteria 3 points which you have, or this is more of which you avoid as order book investing kind of thing?
You're talking about PSUs, right?
Yeah, PSUs and defense railways, all these pockets.
Yeah, so I think I want to share a few different mental models to think about these things. I think the first and the most important thing for people to recognize is that the past is only a good indicator or a good data point to think about the future. It is never the only thing to look at, because otherwise historians would be the richest, right? You cannot obviously just look at history. That is not how it works. History has to inform your view of the future, but you have to think about the fundamental changes that have happened. If people have been carefully observing, a lot of these PSUs have dramatically improved their capital allocation throughout the company as a whole. For example, they are paying more dividends. They are doing more economically viable projects rather than just funding politically motivated projects. All of these things have together meant, for example, you can look at the NPAs and the ROE for the public sector banks. They are really good. So all of this is indication of the fact that capital allocation is increasing, improving in all of these companies, which is why a lot of them, they were at throwaway valuations, and that throwaway valuation has now become maybe a little undervalued. So it went from very, very undervalued to maybe little undervalued, or maybe fair valued in many cases, right? Now, what I want to point out is, for me personally, my thing is to have these three legs to stand on. Most of the companies I have found in this space were high growth, high ROCE, but they were high on valuation also. I am yet to find a single company which is high growth, high ROCE, but high margin of safety also, or low valuation. So that is why I have not been able to own anything very convincingly. I have taken small positions in the likes of MTAR and data pattern in the past, but I wasn't able to scale it up to a large position. And that was the primary reason I had to get out of it, because I didn't have the conviction at that kind of earnings multiple of like 70 times, 80 times. There is no margin of safety. All they have to do is to mess up for a year, and that 80 times earnings can easily go to 20 times, and you lose 75% value as an investor, right? And I mean, for investors who have a small capital base, we cannot afford to make those mistakes early in our journey, or at least I don't think I want to make those kind of mistakes where I don't pay heed to valuation and then I pay for it. So that is why I have not yet owned. But I'm always on the lookout. If I find a good company where I think the risk of government payments is low, valuation is good, competitive advantages are high, growth is high, then I'm going to be happy to evaluate and own.
Right. So Sahil, like IT companies haven't done very good in last 1.5 years, and we had some small rally previously, and select companies are an exception. But again, how you see IT sector going from here? So it will be sideways or not performing for some time, or do you see some traction coming in the sector?
I think, like, again, Prince, like, I will be very, very honest. Like, I don't have sectoral views, primarily because what I have learned the hard way is that every company is actually going through its own journey. You cannot, we cannot put them together in a bucket, even though they're all making information technology kind of software services. We cannot put them in the same bucket. Even in that bucket, there are going to be ER&D companies. There are going to be mechanical or civil engineering companies. There are going to be pure play IT services. There are also going to be product companies. There are going to be small and mid-sized IT companies which are in new age technologies. It's a wide, very wide spectrum. So that is why I think it makes sense to evaluate every company on its own merit. Anyway, see, the thing is, the way I think about it is, if I'm putting a lot of time, I expect that amount of reward also out of the investment. So, I mean, for me personally, uh, going very deep and thinking about owning Infosys and TCS doesn't make any sense. So for me, it's all about, can I find a small sized company which has some probability of appreciation? Those I think there have been enough of in the last year, two, and like any period of time, right? Because see, the base rate is in your favor. If you look at it, the two sectors where there has been high base rate of success are actually IT and NBFC. Meaning, if you take a random set of 100 IT companies of some size, let's say 100 crore revenue, and you look at the scale up to 500 crore, most of them will eventually scale up. Maybe half of them scale up fast, half of them take longer to scale up, but eventually they will scale up. Similarly for NBFCs, small NBFCs becoming medium, mid is a very high probability event. So the base rate of success being high effectively means that these are two sectors where it makes a lot of sense to look at small companies because it's not a winner takes all kind of thing, right? I mean, especially in things like chemicals, you really need scale to be able to compete with China. That is not the case in IT, right? Don't need scale. The primary reason that this works out beautifully is that there is a long tail of clients who are small also, right? Imagine a small retail company in Germany or USA, which has maybe 10 stores, 20 stores. It is not a very big operation. They want to digitize, right? I mean, Infosys cannot think of touching them because it would give them too small amount of revenue. Whereas these small IT companies, for them, this is the perfect client. And for that client, this is the perfect supplier. So they have that synergistic relationship and both can grow on each other's back. It's a win-win situation. So, I mean, basically what I'm saying is I think we should be trying to find small IT companies which are somewhat differentiated, which have a good working culture and, those could be worth owning.
So names not required, Sahil, but anything coming on radar, fulfilling the criteria of investment in the IT
They
space?
do. No, they do come on the radar, but what ends up happening is that they become overvalued, and again, I have to go through that process of like not owning it. But like there are many companies. For example, I've studied Ksolves. That was one company where I thought it was a bit differentiated, primarily because they were very good capital allocators. They are very good capital allocators. I think they raised something like 20 crore from the IPO, and they have returned some 40, 50 crore already in dividends, some very large amount. And in fact, if you look at it, they pay almost their entire operating cash flow as dividend because their logic is that we don't really need any capital. We are an IT company, and that's such a like honest statement. A lot of these IT companies just hoard cash for no good reason, right? But if one company is willing to give very high dividends, I think that makes a lot of sense. But then what happens is over time, the market catches on to these things and these companies become, overvalued or sort of risk reward becomes unfavorable. And at that point, I don't want to own it because then the downside is more than the upside.
Point. So one Praveen Goyal, he is asking Sahil, what is your view on MDF industry after housing sector?
After, sorry, can you repeat that?
Yeah, after China's focus on housing sector.
Right. Actually, like from my study, at least, this is a mostly commoditized industry. There is not really much of a brand, so to speak. The primary reason being that this goes inside, right? It's not a user-facing thing. It's like a back-end thing. Like, how does it matter to the user which MDF you are putting inside my woodwork, right? We really don't care too much about it. So, I mean, I have personally not found the will to study this sector a lot. So, I mean, I have not found any company worth owning here.
Okay, one question is from Aman Kumar. And guys, the forum is like open for questions. So you guys can send in a speaker request. I'll approve and we take your question to Sahil. So Aman Kumar is asking, please suggest about EMS industry, how we can select within this sector.
See, the thing with EMS again is, in my opinion, it is extremely high growth. But the other two criteria are not met. They don't have very good competitive advantages or high ROCEs, and they don't have a low starting valuation. So the margin of safety is also not there, and the ROCs are also not great. Now, of course, there is something to be said about scale, right? So the largest EMS players have a higher probability of scaling up, because imagine it this way: if today you wanted to make 10 million or 100 million units of a mobile phone, how many companies can you go to really? You can't go to too many, right? You can probably go to Dixon. That's one big company. Of course, there are Chinese companies like Foxconn that you can go to. I'm talking about Indian players. So, of course, Dixon will benefit from that, right? But really, it's a contract manufacturer in a very commoditized kind of setup. So, I mean, at least to my mind, these companies are also not worth owning, primarily because this trend has been so well studied and beaten to death that these companies were never available for cheap. They have always been overvalued, at least as far as I have tracked them, right? But there are proxies that we can play it through, because basically, like, the if the broader thesis is electronics manufacturing in India, then you can try to find component manufacturers, companies that make resistors, companies that make capacitors, or components that go into capacitors or resistors. Those companies are much higher probability of success. The reason being that if you look at all of these component manufacturers, the growth in these companies comes more slowly. The reason is that it is in the EMS companies that government has given PLI, right? Only very recently, I mean, as recently as like 3 4 days ago, government has announced a second PLI for component manufacturers, which is essentially capacitor maker kind of companies, capacitors and shunt makers. Now these companies will get a very big competitive advantage against the import of components from China. So until now, China definitely had some cost advantage on some of the components for sure, by 5 6%. This PLI can help bridge that cost gap, and then every single EMS player, including Dixon, will have no reason not to buy from Bharat. All are indigenous manufacturers of components. So these component companies can really now start growing much faster. Of course, one has to study these companies. And of course, the other caveat I want to add is some of these companies are also very well discovered now, right? So at this price, I would not say there is a high margin of safety in any of these companies. The ones that I own or used to own, like Shivalik and Xpro, I don't think there's a good margin of safety there. One can probably get the same returns as the earnings growth, maybe a little bit lower in case they don't execute very well, right? So that risk is also there. But one should always be, in my opinion, on the lookout for these kind of companies, differentiated companies which will benefit. Like as an example, Xpro makes these capacitor films, which are dielectric films, biaxially oriented dielectric films. They are the only manufacturer in India, right? That is the kind of company I want, where basically in case this trend picks up, which I know it's picking up, then there is no other way that anyone else can benefit from it. Because there is a technology barrier to entry here. And it is very difficult for a random person to come, put up a 150 to 200 crore line, and then start manufacturing these kind of films. So, those are the kind of companies through which I am playing it. But my buying prices and my valuations were much lower. So, people should do their own due diligence and try to find similar companies, and not, try to chase the same companies which may be at higher valuations.
Right. So Vineet has one question. So he's asking, how does Ksolves fit into criteria of moat, etc., which was explained earlier? Aren't they working on run of the mill Salesforce solutions?
So I mean that is true to some extent, and like to that extent, all IT companies are actually not having any moat. All IT companies are exactly the same. There's no difference. But one thing that has to be understood is moat is a requirement in general. One thing that has to be understood about investing, which I was saying earlier, is that investing is not a dogmatic thing. It's not that this is dogma, right? Dogma meaning ऐसा नहीं है कि मैं इसको फॉलो नहीं करूंगा तो मुझे पाप लगेगा. I have to figure out where is the exception to the rule also. IT is where the exception to the rule is, because the probability of success is very high, the base rate of success is very high. There, even if there is no moat, companies grow very well. There, I would look at some other differentiator. For example, capital allocation. The fact that in this case, Ksolves is willing to share all the profits as dividend is a very, very welcome thing for a company of their size, because it means that they are not trying to hoard cash or in some way shortchange the minority shareholders. They're trying to take all shareholders along, especially the minority shareholders. So I mean that was the reason I thought that's the differentiation per se, and maybe not a differentiation in the business model but in the way they allocate capital.
Fair point. Shankar Nadakarni, he's asking, when would you sell a company like Xpro that may be overvalued but has a runway ahead?
Yeah, that's a very great point. I mean, for me personally, the trigger to sell is it has to be overvalued, and I need to have some visibility of slowdown in the revenue. Right? If I have both of them, then I would sell it, because then it doesn't make sense. And this is the kind of thing which basically happened for Shivalik. If Shivalik had gone to some 55, 60 times earnings, I think more like 57 was the peak for Shivalik, and the management in the con call was saying that our revenue growth will slow down a bit now. From like just in Q4 they had actually in Q4 they had guided for something like 25% kind of growth to continue, but in the Q1 con call they said it might be closer to 15 to 20% possibly. So that combined with the valuation was that kind of like reason to sell. But in general, I want to let these companies run, because like we discussed, they have a very high runway for growth. Now, one thing I want to point out, which is like something which I actively work on. This is something which I think people like me have to work on, is the ability to track these companies as if I own them. Even if I have sold Shivalik, it absolutely does not mean that I will not track it, because that longevity of growth, that growth runway is still there, even if I have sold it. Now, this demonstrates a very important characteristic which investors need to have, which is the ability to hold two opposing viewpoints in their mind, right? One viewpoint is that it has a high runway for growth and thus deserves to be owned. The other viewpoint is that the valuation is high, near term looks a bit like a slowdown kind of situation, and so it is a sell. Both have to be held simultaneously in the mind. At some point, I might weigh argument one over argument two. But at some point, that might reverse. The order might reverse. Imagine that in Q2, they start saying that all the inventory thing has gone away. Our clients were holding inventory. They're not holding inventory anymore. The demand is very strong, and we expect to be back on our 25% growth trajectory from the next quarter. Then I have to change my views. Depending, of course, on the 360-degree feedback, I would look at what Visha is saying, which is their client. But my broader point is I have to be willing to change my opinion if the facts change. That is the important thing.
So Sahil, like on the sell part, do you think like it changes depending upon the market situation? Say if it is a bull phase, then selling is different, and we are in sideways or a bear market. In that case, the selling criteria would be different. You have some differentiation on this, or it's like quite the same in both the phases?
No, it's the same. It's exactly the same. I mean, the only thing is that the kind of leeway you might give, what you might call overvalued, that might change. And that is more a function of my own psychology also. The way I feel about it, what I think at that moment. At some point, I might feel 60 times earnings is overvalued. At another point, I might feel that, the runway is strong enough, so it's okay. Like there will be that subjectivity of opinion, because one has to understand that investing is equal parts creativity and equal parts science. It's art and science and mixture of both. It is neither 100% scientific and nor 100% just creativity or subjective. It is a mixture, meaning there will be subjectivity in the way that humans act. It cannot be just 100% process, and but we have to try to refine the process part as much as possible. So for me personally, high overvaluation is an immediate sell. Now, one thing I do want to add is, for me, a trigger to sell is if I think that there are better opportunities where I can deploy capital. Meaning, Imagine that my expectation is that my portfolio can give me 25 to 30% kind of return. But I think one specific position is giving me more like 10 to 15% return because of the fact that it is overvalued. Then it is a clear sell because that company is not fitting in with the rest of the portfolio in terms of the return profile because it is overvalued. But I need the alternate places to deploy the capital also. That is important. Imagine that I had no ideas. I just did not know where to put the capital. Let's imagine a hypothetical where every single company I own has become overvalued. My expectation from my portfolio in general is to give me 10-15% return because everything is overvalued and I cannot find any places to deploy my capital. That is the place at which I would probably take a cash call. That, I cannot find better opportunities, so let me sell everything and get into cash. As long as I can find opportunities to deploy capital, it makes no sense to take the cash call. Effectively, the point being, um, basically the like when to sell and what is overvalued, those are more like an absolute thing, but the relative opportunity cost dictates whether I will sell and when I will sell. Meaning, if there is no opportunity cost, if there is no other opportunity, I might give a larger leeway, but I might have to sell everything in that case, and I might have to go 100% into cash.
Fair point, Sahil. So one question is from Shankar is asking, what is the IRR target that you have at portfolio level and threshold and individual investment level?
I mean, see, one thing that has to be understood here is portfolio, IRR, etc. are all a function of, like how much effort we are willing to put. What I can share with you, Shankar, is my experience of talking to a lot of investors. And of course, these are all anecdotal conversations. These are not audited returns because, I can't ask people that I have met once or twice or 5 times that, show me your audited return because they don't owe anything to me. But my anecdotal evidence of talking to investors is that good investors, and many of them, not one, but like more like 20 to 25 maybe, or at least 10 I can probably name by name, have done around, 30-40% over a decade. Good investors have done 30 to 40% over a decade. This is difficult. I'm not saying that everybody can do it. If I were to, post a Twitter poll, probably 30% people would say that I can do 30%, but that is very difficult. Over 10 years. I'm not saying doing it for 1 or 2 years. I'm saying over 10 years, including the bear market, including the 60-70% kind of a downfall and a drawdown. Right. So my expectation from myself is to be on the same scale and basically do as good as the best investors can do in India and Bharat. But of course, that is only an aspirational target, right? I mean, I cannot force those returns. Number one, I cannot force them. Number two, if I have to go down the quality curve for those returns, I will never do that because that is just taking on blow up risk. Basically, I would not want to own EPC companies and PSU banks if I have to get to 30%, right? I still want to own the kind of companies I want to own. With that, the primary target is to know and have peace of mind over the kind of companies I own. Secondary target is IRR. But my experience is that very good investors have done 30-40% over a decade. And I think I should be able to do it too if I'm willing to work as hard as them.
Right. So one question is around KPR Mill. So basically, he's asking, have you any business view over KPR Mill? Its share price has grown at a CAGR of 50% in the last 10 years. Lot of investors has passed it, thinking it's not attractive. How would it fit with your framework if it does?
Like to be honest, I haven't studied it that much, so very hard for me to make a statement on it. But I do see that this person is correct. It has given a 50% price CAGR, and it has very good return on equity across the cycle, and it has a good profit growth also. Of course, like basically the profit CAGR is 23, price CAGR is 51, which means ki a lot of it is re-rating also. from 10 years ago. But the profit has also grown very well, and probably the re-rating is well deserved. Having said that, I mean, 10 years ago, its PE was 4, right? It was at a price to earnings of 4 10 years ago. Now it's at a price to earnings of 33. So, of course, that part of it has gone away, right? That undervaluation has gone away. Now, you have to ask yourself, is this the kind of company? This is a textile value chain company, right? That much I know. They make things like fabric, garments. So now the question is, can it go from 33 times earnings to 60 times earnings? That is when you can get some re-rating, right? I think for most companies, it is very difficult to make that argument. Of course, for some, we can make that argument, but that itself is a craft and it's very subjective to figure that out. If it cannot go from 33 to 60, it will either stay at 33 or it will derate, right? So, I mean, my point is you have to analyze it that way, in my opinion, that what can happen to the PE and then what can happen to the earnings. If the earnings can grow 25%, but we think that it might derate, in that case, the at least to me, it would not make any sense to own.
All right. So another question. So by any chance, you studied shrimp industry?
Even the shrimp industry, we have some of the best companies in India and Bharat, but it is very commoditized in nature. There is a lot of competition from a country called Ecuador. And the thing with Ecuador is that it's geographically closer to USA, which is one of our big end markets. And because of that, like basically, it's like these kind of companies I find very hard to build conviction over because I have to understand, a very complex web of geopolitics and how are different countries interacting with each other. Because, for example, in this case, Ecuador used to earlier supply to China. Then I think China had some, COVID restrictions because of which Ecuador started supplying to USA. Now China has opened up. So will Ecuador supply to China? Will they supply to USA? Will they supply to both? It's very complex. I would treat it like a global commodity, so maybe like steel. Right? Now, of course, I'm not saying there are of course good companies in this. For example, if you look at Avanti Feeds, they have been one of the best companies and a huge wealth creator for its investors. Right? If you look at its price CAGR, similar to what we were discussing, it has given 40% over the last decade. And this 40% is despite the fact that in the last 5 years it has done nothing. In the last 5 years, it has given no returns. So, of course, at some point, the cycle will turn, right? We can't predict what makes the cycle turn, but I mean, at least I can't predict. But somewhere the cycle will turn and the investors will make money. But it is not for me. It does not fit with my framework. And when I want to be very clear, when I say it doesn't fit with my framework, it means even if I ever own it, it would be for a short duration of time on a small allocation, and basically I would be very finicky and fidgety all the time. It would not allow me to sleep peacefully at night the way a shunt resistor maker or a high technology gear company or a film capacitor company would allow me to sleep at night.
Right. So, Hegde, not Ravi. Okay, Ravi. So, Ravi is asking the power T&D value chain seems to be an exciting space given the tremendous investments that will go into over the years, which are some of the interesting companies and equipment suppliers, meters, system integrators, etc. In case you are studying the space.
I haven't studied it very deeply, to be honest. The only company I owned at some point, which is related, is Shivalik Bimetals because they made shunt resistors, which also go into these smart meters. And because of that, I had some exposure to it. Um, Basically, my framework is the same. It has to be a cheap company, there have to be competitive advantages, and there has to be longevity of growth. So I haven't yet found any company which fits those three things. One company which did come on the radar is Apar Industries, but frankly, I could not understand the competitive advantages there. And I don't mind putting companies I don't understand into the too hard pile, because if I understand, can I have the conviction to own it? Otherwise, no, it won't let me sleep at night.
Right. So Soham has question more on the behavior side. So he's asking how to protect ourselves from paying high, and is there any checklist like for when to buy, kind of?
I mean, see, the thing that I feel is, if we are willing to work hard enough, why should we settle for mediocre outcomes, right? And buying a company at high valuation is precisely going to result in high mediocre outcomes, because very, very rare companies can sustain that high multiple. In the last 10 or 20 years, we can probably count on our fingertips the likes of Asian Paints, the likes of Relaxo, the likes of Astral, which have sustained that high multiple throughout decades, right? Most companies do not sustain that high multiple, and they typically derate over time as they have a low profit CAGR, right? They just derate over time. So my point is, this is a low probability, like basically low probability of success kind of space, where you're paying 70 times earnings. If the growth slows down, you get derating. If the quality of growth slows down, which means ROE gets diluted, you get derating. If the quality of cash flow slows down and the working capital extends, you get derating, because they will have to raise equity. So basically, the odds are stacked against you. As simple as that. So I think the behavioral aspect, the way I would want to say that one can tackle it, at least I tackle it, is by studying more companies, right? At no point do I want to be in a situation where I don't have alternatives or I don't have other companies to own. Even today, if let's say there was a gun to my head and I was forced to sell all the companies that I own, I think I have another bench of 10, 15 companies that I can own, which would give me lower returns, but very respectable returns. And I always want to be in that situation where I have like a sorted list of companies in my head.
Right, Sahil. So another question is on movie tech domain, including VFX and SFX. Any view on this industry? Ex Intel chief architect has founded a very interesting startup, Mihira AI. Are there any listed companies in this space or any company which you find interesting?
See, there are companies in this space. They are very small, so I will, refrain from naming them. But what I do want to say in general is that the trend of services export from Bharat have just started in the last 2, 3 years beyond IT. So of course, IT has been a multi-decade trend from like last 25 years or so. Beyond IT, we just started last 2, 3 years, and this is going to, I think, continue for the next 20 years. There are many of these industries which definitely have the potential to become like the next IT, right? There is this learning and development kind of industry. There's an industry of civil and mechanical engineering services. There is industry of VFX, which is visual effects, and I'm sure we can find many such other services industries, things like accountancy, law, which I mean, ideally, Bharat can do all of this for the entire world, right? See, the point is, if your American lawyer can sit at home, work from home, and file your cases in the American courts, why can't a Bharatiya lawyer sitting here in Bharat do the same thing for you? And they will do it at maybe one third the cost or one fourth the cost, right? So it's a win-win. Everybody wins. So this is a trend which should pick up. It has to pick up. It has started picking up, and we have to find the companies which are best placed to benefit from it.
Right. So one question again is, what are some antitheses we need to look at whole investing in a product company?
Sorry, I didn't understand what is a product company.
What are some antitheses we need to look at while investing in a product company?
I don't know what they mean by product company, but I can maybe talk in general. See, the thing that has to be always understood by an investor is that all of investing literature, yeah, फिर whatever you write, whether you consider it to be a Twitter thread, You consider it to be an investing rationale written by you for yourself. You consider it to be books written by investors. You consider it to be YouTube videos made by people. All of this is just very subjective stories that we tell ourselves, right? We are simply trying to create stories that explain the numbers that we see in front of ourselves. What that is implying is that because reality is dynamic and companies are in a network with each other, right? It's not just a linear thing. There are second order, nth order effects of things. Because of this, reality can change very fast, right? It is not going to, wait around for the thesis to update. What I mean by that is we have to continuously monitor the world for the reality. What is going on the ground? What are the companies in the ecosystem of my investee company saying? For example, for Shivalik Biometals, I would want to see what their largest client Vishay is saying, what their client Tesla is saying. I would want to see all of those things. And it has to make sense as a whole, at an ecosystem level, it has to make sense. It cannot just be that, company one is saying something, company two is saying something, and they don't match up, right? That is not an investing thesis. What I'm trying to point out is we have to continuously look for disagreements or things that don't add up, right? Typically, that is where the thesis has broken down. So I can give you one example. If you take the case of Loris, right? I think Loris was saying that there is no one-off element. We have very good growth, but if you looked at some of its companies which are in the same value chain, for example, Naveen makes some of the API intermediates for ARVs, right? I mean these are intermediates. They don't make the API; they make the intermediates. If you look at Naveen, they had started giving that caution that ARV intermediates is facing demand shocks. There is inventory pileup, and because of that, we can have some poor quarters. If you looked at data from the largest buyers of the world, this is known as a global fund, which basically buys for the AIDS eradication program in Africa and maybe some other countries also. This is the largest buyer. This is an institutional, global institution kind of buyer. This is not an individual country or government. They also had projected buying less next year compared to this year. There were many such data points which were visible, which could have convinced the investor, including, for example, that one of the brokers, I think it was Kotak, had put out a warning that a lot of the profits that Loris is getting is from the one-off Paxlovid that they are shipping right now to Pfizer, and this can go down, and so the degrowth can happen in the future. All of these were visible to the investor, right? All you had to do was look at the Pfizer con calls, look at what they were saying about Paxlovid. You had to do that, adding the 2 plus 2 together. You could make out that things can go against me also in this case, right? So then, if it was at 40 times earnings, that is a stressed valuation for a company where you see so many signs of trouble. It does not matter what the management is saying. And frankly, I don't believe that we should be blaming the management or raising questions about them, because it is our job as investors to do a 360-degree scuttlebutt and form our own individual independent opinions, right? I feel like the management guidance is just one data point. It should not be the bulk of what an investor relies on to have their investment thesis. So broader point being that basically 360-degree monitoring has to be done so that we are on top of reality and what's going on in the world with respect to our company and its value chain, and then we can take the decision to sell or not to own it at some point.
Right. And for our attendees, like I'm seeing requests, but I'm unable to. I mean, they are not visible. I see 4, 5 requests pending. So what I'm doing is like whichever questions are relevant in the comments, I'm reading out to Sahil, and still you can send in a request. If I'll get it, I'll approve, and we can take the questions. So meanwhile, Sahil, I think not in good shape as far as like health is concerned. So please have some water in between. Let me find an interesting question for you. So Sushil Kumar is asking, what is your view on Bharat, Middle East, and Europe rail and shipping connectivity corridor announced today in G20? Which are the companies likely to benefit from this, if any?
See, I want us to understand two, three very important things which we have to hold in our mind. Number one, I think people should look at developments and try to think of the holistic implications of those developments. For example, most people would think that these G20 kind of things are irrelevant. Maybe in the most part they are, right? But it does not mean that we should not consume that and understand it, because it can have implications for our investments also. In this specific case, if you had heard that complete event, the European Union commissioner said that this would reduce the travel time from Bharat to Europe for the goods by 40%, right? What does that mean? That means the inventory in transit goes down by 40%. Costs can also potentially go down, because basically you don't have to have that much manpower and all of that additional overhead, right? Which you have to pay them if they are on a ship for 40% more time. All of that goes down. The fuel cost goes down, right? Because 40% lesser. Now, the thing I'm driving at is many of these companies that we own do a lot of shipments to Europe, right? A lot of them get maybe 40, 50, 60% revenues from their shipments to Europe. All of them will have a dramatic fall in the working capital and a dramatic fall in the cost of transportation. This would make them more competitive and healthier, right? And this exact thing is happening even by the infra projects happening inside the company, inside the country. If you look at all these expressways and national highways being built, this Delhi Mumbai expressway, right? Delhi Mumbai expressway is to be thought of not just, keep people will drive from Delhi to Mumbai. It has to be thought of in the sense that a small company having a factory in Uttar Pradesh now becomes competitive to ship its products globally, because it can get them delivered to Mumbai port in maybe 12 hours, right? And from there, of course, we are working on the outside country logistics also. All of these should ideally increase the rate of exports, right? But these are very long term kind of things. They will not impact tomorrow. These will take maybe 5 years, 10 years to implement, depending on, because they also have multiple countries that are involved, right? In this case, there is at least three countries in the Middle East. There is Bharat, there is USA. All of them have to coordinate. It can take time. And as with anything else, if you do five such schemes, only two or three might succeed, because in other cases, there can be, like, imagine if one of the middle countries like Jordan says, I will not do it, right? Then you can't do it, then it falls through. So, I mean, there are many variables which have to fall into place, but that opportunity is there for improvement in the logistics costs.
Right side. So next question is from Nafas. He's asking, "Hi Sahil, since people are showing great interest in investing capital markets and sorry liquid assets, do you foresee great opportunities in wealth management industry in the longer term?"
Certainly, I think the wealth management space is a very good one. But one thing I always feel about this space is I find it exceedingly hard to figure out the competitive advantage of uh, companies. For example, what I have heard about wealth is that it's about the relationship. But I mean, somehow that is very irrational behavior to me. Like, I would want to give my money to the manager who's the best. It doesn't matter who I have a relationship with or don't have a relationship with, right? So, I mean, at least to me, I find it hard to understand the drivers of this industry. Maybe if I were to talk to more wealth managers, understand how they work, why is it that, the relationships matter much more than maybe the track record? Like, why is it not that the best fund managers get all the money, right? Ideally, they should get all the money. The person who can really grow at 25% for a long duration of time. I know of one such PMS. I talked about it recently. It's called Nine Rivers Capital, I think, or something like that. They have grown at 28, 29% over the last 10 years. They only have 800 crore AUM. How does that make any sense? I don't understand. Because there are, PMSs which have much worse returns who are managing 12,000 crores, right? Does that make any sense? To me, it doesn't make any sense. I don't understand how that works. So I have to understand better, like, the drivers for it. But I agree with them in principle that this thing should do very, very well. Primarily, because if you look around you, most people who have money still have a lot of money parked in real estate and gold, kind of like, hard assets and unproductive assets. A lot of this has to come into the equity market, one way or another, right? So I think that has to be looked at. There can be other financial market participants who benefit. It may not just be a wealth manager. For example, I was studying this company called Prudent, which is a mutual fund distributor and distribution platform. They look like an interesting company. Of course, they have that terminal value risk where everybody shifts to ETFs and direct mutual funds. Then there are other proxies like CDSL. There is NSC, which is unlisted right now. There is BSC. Then there are brokers like Angel. So I think there are lots of ways of playing this, but one has to figure out what they are comfortable with. At this point, I own Angel because I find a lot of comfort in the way that FNO volumes are going. I mean, we are treating it just like a lottery here in Bharat. Of course, this is not good behavior, but my logic is there is no way I can convince people don't do it, right? I mean, I keep telling them not to do it, but if they are doing it, might as well. I mean, if the broker is earning profits, we might as well get some of those profits as investors.
Fair point, Sahil. Agree on that. So Mahesh Atal, he's asking, when you say about component industry, do you think that these companies will have high PE, such as Xpro has got, and do you believe Xpro will be able to pull off, as the new capex could also turn on the wrong side? They may go wrong on product. What's your view?
See, in these cases, you have to understand a few different things. One is that, of course, if I own it, then I do believe that they will pull it off. If I didn't believe that, I would have sold it, right? The second thing, I mean, basically, it's like asking a barber, do you want a haircut? The barber will always say, yes, you should get a haircut. Even if you have zero hair, the barber will just want to, run their scissors and charge you for it, right? So you're asking a very, very biased person whether they can execute well. I obviously believe that they can execute well, and that's why I own it. The other thing that has to be understood is that I have talked to some of their clients also in a private capacity, and what I have learned is that the clients are very looking forward to buying from them. So I mean, there is no shortage of demand per se in this case. It's about their execution capability, which I think they have lot of it. If you go through the con calls, if you go through the annual report, you can form your independent opinion on it. But at least my opinion is that they have everything it takes. Of course, that PE ratio, the market has re-rated it. But see, this is why when let's say I wrote the thread, it was at 650. Now the fascinating thing, after I wrote the thread, it went to 550, right? So 20%, 25% below my initial buying price. At that point, what were the market participants doing? If they were studying, they could have bought. But I don't know if they were studying at that point. They might have been thinking, it has gone against him. See, we have to understand the price is never an indicator uh, in the short term. Of course, in the long term, if let's say something has destroyed wealth over 10 years, that is an indicator. In a short term, there can be volatility for no good reason, basically. Um, Not all price moves are backed by fundamentals. Some of them are backed by speculative action, right? So, I mean, we have to figure out as investors in what cases these are justified moves. For example, in the case of Loris, where there was these one-off earnings, DVs, where there was one-off earnings, there it was justified. In the case of Xpro, there was no justification for the simple reason that there is nothing that is changing in the business, right? Why should it go from 650 to 550? Um, that was a great opportunity to add. And like I added, but probably not as much as I would have loved to add. I added a little bit, not that much. That is a learning for me also. Like I should have added more. But my broader point is, see, we have to be prepared. That's the thing that like people should take home, right? If somebody, you see someone talking about a company, go home, do your homework, be prepared, form your independent thesis and independent conviction, right? Don't wait for market to agree, because if market agrees, then you won't get the PE multiple or the margin of safety. In that way, one thing I want to add is that investing is a very lonely profession, because when we first start talking about companies, people don't want to talk about it. They are going to say, oh no, this is nothing, this is just overvalued, this is chore promoter, and all kinds of narratives and counter thesis that you can think of, right? Very independent, only independent minded people can do this very well.
All right. And some attendees are asking whether this is recorded. Yes, this is recorded and will be uploading on my YouTube channel, and also Sahil will be uploading the same on his channel. So you can surely revisit. And there are some questions which are repetitive in the sense which we covered with Sahil in the first interaction. So you guys can surely listen to that conversation on my YouTube channel. So one good questions I like, although Shankar has asked too many questions, last question from him. Do you look at tax implications at the time of selling a position to enter into another opportunity with a slightly better opportunity?
I mean, see, the way I think about these things is like, what is the problem in paying taxes here? I mean, I want to pay as much taxes as I can because my logic is that if I'm paying a lot of taxes, I'm making a lot of profits. So, like, what's the problem here? Our incentives are aligned. I don't pay taxes if I don't make profits now. I only pay taxes if I make profits. So I don't at all optimize for taxes. I optimize for what I think is the right decision. Imagine I bought a company at 15 times earnings. My thesis is that it can grow 20%. And so it is undervalued at 15 times earnings, right? That company within 2 or 3 months goes to 30, 35 times earnings, right? From 15 it went to 30 or 35 within 2 months. What I thought would be my return in 3 years, market gave me in 3 months. Should I should I just hold that company? How does that make any sense? Because I don't think it is worth 30 times earnings. I think it is overvalued at that price. Now I can see some antithesis. In fact, I want this to be, if people want to attribute one saying to me, attribute this one saying that at a low valuation, I am an optimist. In the same company at a high valuation, I am a pessimist, right? So I mean, my pessimism and optimism have to depend on what is embedded in the price. If the same company has doubled in 1 or 3 months, I am a pessimist at that price because the risk reward has changed. Right now, I have to think of the downside, not the upside. So point is, if I have made 100% gains, I sell the company. I have to pay the government 15% tax. How does it matter? Right? I have made a large amount of profit. And frankly, on your salary, if you're paying 35, 37%, then 15% seems like a good deal. And like, I'm happy with it.
Mr. Babulal, you can unmute and ask your question, please. Mr. Babulal, you are still on mute. Okay, so let me. So S Ray has a question, although repetitive. Which portal tools should we use for shortlisting? Is it only screener or although we discussed, but again, if you want to take Sahil.
So actually, the recent thing I started, one of my mentors and people I really look up to is Manoj sir, Manoj Duaji. I follow him on Twitter also. He has spoken on this thing called Smart Sync Services. He has an interview. So Manoj ji told me recently that at our age we should be ideally studying all companies. Why do we even need a screener? Just study all the companies. There are only 5,000 companies. It might take me a few years, but why not study all the companies? Actually, that is what I have started very recently. That I want to study every company to some level of depth. Whether I go deep enough or not will depend on whether I find it interesting, right? That part will always remain. But right now, what I'm doing is I have made a list of some, 1,000 or so companies based on some parameters, and now I'm going to study all 1,000. After that, I'm going to go after, some other 1,000 basically. So in that way, I plan to study all companies. So I mean, this is something which a person had asked Warren Buffett in a Berkshire AGM that there are so many companies. How do I start? And the reply that Warren Buffett gave is start with the A's, right? In Bharat, I think we have companies whose name starts with 1 and 3. We have 3M India, right? So I would say start with the threes.
Great, right. So Lokesh has a question. How do you find the upcoming trends? How can a new investor pick them up?
I think a lot of it is about, looking at changes around us, like listening to podcasts. I have a lot of, podcasting heroes or like people I love to listen to. For example, this is one podcast called All In Podcast, right? It's about a bunch of billionaire entrepreneurs. I think, like, imagine how lucky we would have to be that four billionaires thought it is worth their time to talk about entrepreneurship and the trends they see in venture capital angel investing in their investments to all of us, right? And we can listen to it for free. Right? Imagine what kind of a day and age we live in, right? So this is the cutting edge of venture capital in US, right? All in podcast. Then there is a podcast by Nikhil Kamath. He's one of the co-founders of Zerodha. He has a very good podcast on basically a similar kind of theme where he talks to a lot of the entrepreneurs about different themes. He has talked about venture, he has talked about building brands, he has talked about biotech. So I love listening to these kind of podcasts. A lot of these places are good hunting ground, and then we have to read a lot, right? That's the main thing. If you read a lot, you are just expanding your area of luck, right? You will, of course, eventually reach these kind of conclusions that EVs have this lower cost of total ownership, so anybody that is looking at it economically would never buy an ICE. Like today I cannot buy an ICE if I'm looking at total cost of ownership, right? If I am thinking about the environment, I cannot buy an ICE. ICE is strictly worse than EV. EVs may not be great, but they are good and they are better than ICE, right? Eventually they will be great. So I mean, if you're thinking along those lines, if you're reading a lot, you will you will hit a lot of these similar kind of trends.
Right. And guys, with this interesting conversation, would appreciate if you connect with us and follow our YouTube channel, because it takes a lot of effort to bring so many renowned names in the industry who share their knowledge selflessly, and that help you big time. So next question, Sahil. Sahil, like you had a bad throat, so how good we are on time? I mean, questions will be never ending.
Yeah, I think we can continue for some time, maybe like 10-15
Okay.
minutes maybe.
Okay, great. Okay, so next question. It's a good question. So, what is the value of management meeting in your investment framework?
I think it's
ऑडियो
sort
मिसिंग
of
मेरा
like,
हाँ तो हैपन कैन
hello.
हेलो
Yes, Sahil.
Yeah, hi. I think someone got unmuted.
Maybe Babulal ji.
कैन आई
मैंने
स्पीक
ask
नाउ
Yeah, Babulal ji,
after
you can
after
ask.
this question. After this question, Babulal.
श्योर
The question on management meetings. See, what I feel is that our primary focus is to understand the company, right? That is the main thing. We should use every tool that is at our disposal to try and understand the company. Management meeting is one tool and it would give you some data and some information. It has to be treated as a part of a holistic framework along with the rest of the data. So, the industry scuttlebutt talking to suppliers, clients, competitors, employees, all of that matters. Talking to management also matters. All of it we should try to holistically put together and have an independent opinion. Meaning we cannot over index on what the management is saying. And obviously we should not 100% disregard what they are saying also.
Babulal ji, you can unmute and ask your question.
दिस इज अबाउट the demerger of the all cargo logistic, the two company which came out, which went almost unnoticed. Trans India, I found big value in the company, so I started investing after it came to 30. Now I was trying to put suggestion to SEBI that whenever listing take place, 1 week before at least, the total financial data should be uploaded on the BSE. Otherwise, people are in dark of opportunity.
Thanks. So, Anupam, you can unmute and ask your question, please.
Yeah, hi Sahil.
Hi, sir. Hi.
So one of the things that I wanted to ask you, basically, that you are invested in Angel currently. and you do know that India is like Khelo India, Khelo Chal raha hai in this. So when is like that you're gonna exit, because this is gonna burst sometime or the other. So what are the indicators? Like I'm asking this because in two ways I'm asking how to exit, and other way you can demonstrate your case study in this also.
Yeah, I think, see, there are two things to understand, right? One is, um, you have to understand why people are doing this. In any kind of a developing country, people have a lot more trust in luck and lottery than in hard work, because they don't see a hard correlation between hard work and outcomes. Right? And I think this is something everybody would agree with. I have seen so many hardworking people around me that couldn't do very well because of luck, lack of luck. Right? So if anyways luck plays a large part, people are not making probability calculations. They're thinking अगर luck ही है तो luck यहाँ पे भी try कर लेंगे. Right? So simple thing I'm saying is, frankly, I am not of the opinion that this will blow up, right? I think that it can be slowed down. Like ऐसा हो सकता है कि it stops growing, it goes back to being let's say stagnant, right? The reason it does not, at least to me, seem like it will blow up is we don't have too many equity market participants. Even if you look at these traders and FNO participants, there would be hardly some 10 lakh FNO participants even today. FNO volumes have grown up, but there are not too many people who are doing FNO. That number is not very high, right? It's just that those small number of people are doing very large volumes, right? Now, either they're making lots of profits, or they're in it for the entertainment, right? People are going to Delta Royale in Goa and they're gambling their money, right? Why do we allow that? Because they want entertainment. So my logic is, if people have an emotional outcome here, then it's like Netflix. It is like entertainment, right? Let them play with their money. Obviously, the regulators should do everything they can so that there are enough disclosures so that people know that this is, very risky and they can lose all their money. So education is the way out. That you have to educate people on the outcomes. But if despite that they want to gamble, then all the best to them for gambling. Now, how would we monitor and how would we think about the exit? What we have to understand is NSE has a daily, NSE and BSE both have a daily publication of the FNO volumes. So at a daily cadence, you can see what are the volumes. Basically, that means at every point you can monitor the rolling 7 days, 30-day volumes. You can see the average of the last 7 days, average of the last 30 days, and then you can plot it on a graph, right? And then you simply look at it, whatever. If you think it has gone down by 10% from the peak, then you can exit, right? I mean, at that point it would be subjective. Some people would say 10% is a small fall, it can recover. Others would want to do it at 20. But my point is, there is enough data that can allow us to exit at our convenient point.
Right.
Thanks, Sahil. Another question would be from me. You're saying that a lot of things that at times in your scenario there's some tailwind in the sector that you see. So any sector that currently that you're saying that is still in the tailwind, or like it has run up, but the way is much more to go for the
I
next four or
think
5 years, if you would say.
I think the biggest one is definitely electronics. Electronics is the I think it's a mega power 500 trend, because like the amount of electronics around us is only going to increase over time. It's not going to decrease, right? We need to give a laptop to every single person in this country, right? Why should we not have 1.4 billion laptops? Secondly, we have to give laptops to people in Africa also, right? We have to give laptops to everybody. Where will all those laptops get made? Secondly, we have to make electronics cars now, right? We have to make electric vehicles. We have to make Ola scooters. All of those need those screens, those displays from which you interact. So all of that electronics will get made right here, right? And then that electronics requires components that will get made here. Then you need power electronics, basically, AC to DC conversion, DC to AC conversion. All of that will also get made here. So if you actually study this space, you will find so many companies which are actually into this space. There's permanent magnets, there's Shivalik Biometals, there is Xpro. Um, I'm sure we can find more. There is one called RIR Power. I think we can find like so many companies if we just look for it diligently enough. Of course, there are the EMS companies like Dixon, Keynes, Avalon. All of these EMS companies are also there, and then there are component companies and more like technology companies. See, the primary reason that I am studying all the companies is to uncover these companies which nobody is talking about, right? But they are going to be, I can find them only by studying all companies because many of them may not yet have good numbers because lot of the policy, lot of the government support is only coming today. For example, like I said, the component PLI got announced like 4 days ago, right? Without that component PLI support, many companies may not have a good government support. They may not be competitive. With the PLI, they might become competitive. So I have to study a lot to be able to find the unique companies. Many are known. I'm sure many will become known. Many will list also, which are not listed today. At least to me personally, electronics is the biggest thing.
Okay,
Right.
thanks, Sahil. Thanks, Sahil, for the answer.
Thank you. So, Jay Singh Madhukar is asking, what's your view on healthcare industry and basket of stocks in it?
To be honest with you, in the healthcare industry, I don't find any of the companies very undervalued. A lot of the companies which I find attractive are overvalued. That does not mean, I mean, I'll monitor them at some frequency, but I cannot own them. For example, one company I love here is Polymedicure. Polymedicure, if you look at its graph of sales and profits, it has grown exactly like an FMCG in the last 15 to 17 years, right? Quarter on quarter growth, right? They're actually a medical consumable company. They make these IV cannulas and all. So let's say you are getting a blood transfusion, those plastic consumables which get used, that is what Polymedicure makes. They have recently started making kidney dialyzers. So the ones that do dialysis, that is also something Polymedicure makes. So during the COVID time, I was able to buy it at 30 times earnings, right? From 30, it went to 90, right? 90 is where I thought, it's very overvalued and I was, forced to sell it. Today it's at 62 times earnings. Now, again, I don't find a margin of safety at these valuations, right? It might, I'm sure, grow at 20-25%. At 60 times earnings, I don't find a margin of safety. Similarly, I have studied most of the hospitals. I found Rainbow Children Hospital probably the best one, which I thought I can own. There are lots of reasons for it, but basically the TLDR is that children hospital is where there is very less regulation. Government is not trying to put any price caps, and the ROE profile is very good, very good ROE profile, because of which even when they do capex, they make very good money. So this is like one of the unique business models, children's hospital, where you can keep doing capex and still make good money. And they are probably the largest one also in Bharat, and I think they have like 15-20% of the dedicated children hospital beds in all of Bharat, right? So what that means is very good market dominance. But again, it's at 48 times earnings. At that kind of valuation, I become less interested in owning it. So I have studied many such companies which I found interesting, but I don't own any right now.
So, Sahil, one question is around the wine industry. What's the view on current valuations?
I think like again, similar to most of the FMCG kind of companies, this wine company is also like it has that high runway of a growth. It has that aspirational value where most people want to drink wines. It's a kind of a, let's say, status symbol, or it shows like in some way that you have made it or whatever you want to call it. So I think they're talking about Sula Vineyards. um, but again, at 42 times earnings, like I'm not willing to buy. Maybe if it has a couple of bad years, it comes down to 20 times earnings. Then I can monitor the con calls, try to build the conviction that is this a one-time slowdown. But at 42 times earnings, like I'm not that confident.
Abhishek Jain has a question. India imports 75% from Bangladesh. Isn't this a big risk in light of government focus on Make in India?
Sorry, import what?
Red Tape imports 75% from Bangladesh. Isn't this a big risk in light of government's focus on Make in India?
Yeah, see, what has to be understood is that any company, including red tape, is trying to optimize for its value chain, right? So I'm sure they also know about that risk. At some point, if they think that making it is easy or reasonable in India, then I'm sure they will also start making it, right? So, I mean, basically, think of it like a choice. It's a dynamic choice, right? It's not that they have married that choice, right? So, 25% they are making in their own factory, which is in Unnao, right? I'm sure their logic is to try and learn how to make it, improve the quality, perfect the quality. Once they have that perfection, then they might scale up the manufacture, right? So I think we have to understand those things. I am very hopeful that they might start doing con calls. If they don't, I intend to ask this in the AGM if I can, if they give me an opportunity. And then I would also actually love to ask around this that what is their strategy? Why are they making 25? Why not make either 0 or 100, right? Either make everything or make nothing. Why this 25, 75? So I mean that's a great question. Let's see what they say, but I think it's not a deal breaker.
So one question is from Pankaj Agarwal. So he's asking, can we predict the cases like Jet Airways, Yes Bank, Coffee Day, Sahara, Satyam, M3M in advance by seeing the financials or maybe balance sheets of the company? Can we predict in advance, or it's all in hindsight that we come across these frauds in the company?
I think the many can be predicted, and when we say predicted, and see all of it is probabilistic, right? So like if you want to avoid Satyam Yes Bank, you might end up avoiding some other companies also, right? That is the cost of it. You have to figure out which are you more comfortable with, error of omission or error of commission. Are you more comfortable that you miss out on some of these companies, or are you more comfortable that you want to never lose any money in any company? That is what investors have to figure out. I think another thing that really helps is a 360-degree feedback from market participants, looking at alternate data points. For example, equity investors are willing to underwrite risk, so equity markets are a little more forgiving. The debt markets or the bond markets are not forgiving because they have a capped upside. They have a concavity in the instrument, right? Meaning that their upside is limited, their downside is unlimited. Upside they can make 7%, downside they can lose all the money, right? I'm talking about debt instruments. So what one can see is that what are the valuations at which the bonds for that company are trading. They are issuing debt, right? कितने पे debt issue कर रहे हैं? For example, if Yes Bank is issuing debt at 11%, that itself shows you how risky it is, right? Compared to some other companies. So look at the AAA rated or whatever is the rating. Look at the bonds for HDFC Bank. Look at the bonds for Kotak Bank. Look at the bonds for Bajaj Finance. Then compare it to the bonds for IDFC Bank. Compare it to the bonds for Yes Bank. Those things can be alternate data points. So I think the key thing is to have your eyes and ears open all the time and actively look for this kind of antithesis.
Right side. So Ravi, any questions on your end? So Sahil, like, okay, yeah, Ravi, go ahead.
Yeah, Style, anything you have understanding or read on Fortis, you were talking about the hospital business. And I guess someone was asking on Mirza, the thing I guess Indian government has done is few of the companies in that Agra belt, because of cleaning of Ganga, there was some restriction and hence many shifted to Bangladesh, all the leather companies. This was a diversification or business protection strategy, you may call, from leather manufacturer. I guess that was the reason for shifting to Bangladesh.
Actually, like, yeah, basically, like one thing is that red tape actually is not even into leather shoes anymore. So leather though is not a big thing. It's the sports shoes and the fashion kind of shoes. But one more thing that has to be understood is, from my understanding, we have very good relations with Bangladesh as a country, right? So I mean, like the way we would want to substitute for China, we may not want to substitute for Bangladesh. right? It's very next door and one of the more cooperative neighbors we have. We obviously don't want to have poor ties with every single neighbor, right? Kahin to we need friends also. So my point is like we may not want to switch too much from Bangladesh. It's not a China plus one kind of thing where there is an urgency to have full independence. Second thing is, see, if it gets developed in India and they think that it has the high economic value, they will just make the switch, right? I mean, see, we have to have evaluation of the management, in my opinion. If we have evaluated the management to be efficient and competent, then these micro details have to be left to the management. We can ask them questions to understand their strategy for sure. But then it's at the end of the day about trusting the management to do what is right for the business. Because for me, it might be just 10% position. For Shuja Mirza, it's like a 90%, 95% position, right? He has the highest skill in the game. So I'm sure he will look at the right data to make the right decision. And what was the other question? Sorry, if you can repeat it, Prince.
Ravi, what was it?
Fortis?
Ravi, you are
Yeah,
on
ask,
mute.
yeah, was asking about Fortis if you have any view.
I haven't read Fortis, but see, my framework is extremely simple. I want to study and own companies that have a differentiated business model. They have a high growth, highly profitable growth, high cash flows if possible, and in that order, and then undervaluation. Now, the thing that made me very interested in Rainbow is the unique thing that it's a children's hospital, right? And then I could see that it's sort of unique in that way. Like with Fortis and Apollo and Max, I have not gotten that motivation to study them. So I don't have a good unique opinion about.
Okay. So, Sahil, although we've pretty well covered many ideas during the conversation, but before we close or maybe end the discussion, anything interesting without naming the companies, any space, two, three interesting maybe companies without naming them or space if you would like to talk about?
Yeah, there are many of them. So actually, in terms of what I own, there is one company which makes these precision engineered tubes that go into auto sector, which is basically it's a structural tube. So if let's say you look at a motorbike, you see these tubular things which are like in the structure of the motorbike. If you look at a car, you will see similar kind of tubes which are in the structure. These tubes are made by two companies in India. The largest one is called Tube Investments, which has 60-70% domestic market share. And then there is a smaller company which has maybe 30% domestic market share, and then it does a lot of export also. So these companies, like primarily my thing is I want to find undervalued companies, which I think might grow 20-30% profitably with some barriers to entry in the future, right? So all of these things we are able to do very well.
Right. So let me scan the questions one last time. If there would be any interesting, then only stock specific I'll avoid. And also, just in case, I mean, although we had so many questions, but again, something you had in your mind and is not yet covered, you want to speak about.
No, it sounds good.
Okay, let me check the questions then. Okay, okay. So, one question is around quick heal technology. What is your view on the company's business and its market cap is just approx 1,000 odd crore.
I haven't studied it to be honest, but in general, what I feel is I don't want to study companies which are a turnaround, right? If you tell me a company which has degrown its sales in 5 years, which is unprofitable, I would not study it because there are too many companies which are executing well and undervalued, right? I will come to turnarounds when there are no companies left which are, executing well and undervalued.
Right, Sahil. So, Sahil, anything to conclude the session? Despite your session, you answered so many questions, and surely, if there would be any unanswered relevant question, we'll try to take up in the comments. And guys, there are many questions which were specifically covered in first session with Sahil. So I would request each and every one of you, those who have not yet listened to the conversation, to go through it. Surely love the conversation, and again, you can surely listen to this conversation also again if you joined late. So yeah, Sahil, before we wrap up, and I also see Jiten sir and Swarnish, just in case they are free, they can also chip in and uh, can share their views around the ongoing discussion before we wrap up. Yeah, Sahil.
Um, yeah, so I mean, see, one thing I feel is one definitely has to be cautious. There are lots of companies which are trading at nosebleed valuations where the story is well discovered, but it's, overpriced on that story. So I think one has to be very disciplined in their approach to ownership. Um, I am a permanent buy and hold on equity as an asset class because I think out of 5,000 companies, I should be able to find something that is worth owning, right? Imagine I had a gun to my head, I had to sell everything. Look at the paper stocks and how cheap they are, right? Even the best paper company until recently was at 5 times earnings, right? And it's growing its volumes at maybe 15-20%. So my point is there has to be something worth owning. We just have to work hard enough to find those companies where the risk reward is in our favor and we understand and we are peaceful owning it. So I mean, I'm buy and hold on equity as an asset class, but we have to be very careful of individual names and we should ideally not own companies which have tremendous euphoria built in. Otherwise, we can get surprised on the downside. Like especially 70 PE companies, I don't want to own them. Like if I buy a company at 20 or 30 times earnings and it goes to 70, then I'm happy to sell it. That's the other way to think about it. And I'm very uncomfortable studying a company at 70 times earnings. With those caveats, I think there are enough opportunities. There are enough places where in my opinion, earnings would compound at 20-25%. And so, capital should also compound at 20-25%. I would urge everybody to, work hard because this period of 20 years, which is in front of us, is like a very unique period. Because, before this period, we did not have the kind of access to information. Like, imagine if I were born 20 years earlier, how would I even have studied, I know, in 2000s? There was no internet. There was no way to even call people. I didn't know anybody. I could not even know anybody. I was just sitting at my home. How would I have even studied these companies? It would have been very difficult, right? Today I have all the information in front of me. We have the demographic dividend in front of us. We have very good structural policy reforms happening all around us. Ease of doing business going up. Companies being able to manufacture, export, getting the right incentives in the form of PLI, getting the right logistics so that they are able to export it. All of those things are happening. I think all of us should benefit from these trends because I mean this is once in a lifetime, not just for us, even for our children, right? Imagine 30 years down the line, I don't think they will have that opportunity because we would have very matured as a country, right? Imagine if the average age is 40, 50, it becomes very, very hard to, then grow at 7, 8% from that, let's say 14 trillion or whatever that number is 30 years later. So I think this is a once in multi-lifetime opportunity which has to be capitalized by us. It makes perfect sense, in my opinion, to give every single weekend to equity investing for everyone that is willing to work hard. So I wish all the best to everybody and happy weekend.
Sahil. So, Sahil, before we close here, there is one question from Happy. He asked in the beginning, I forgot to ask. So, he's asking, please ask about Mestec and Kelton Tech on AI perspective and its future growth, if any view.
I haven't studied Kelton. See, one thing that I will again emphasize on IT companies is that a lot of them are not very differentiated IT services companies. So it has to be a valuation play where like you get it so cheap that it is, a no-brainer. So Mastech at 15 times earnings is a no-brainer because it can definitely grow at 20-25%, right? Their stated aim is to grow at 25. Even in a bad environment, I think they can do 20. So it is a no-brainer at 15. But at 20-25 times, it becomes more like fair valued. At 30-35 times, it becomes more like a little bit overvalued also, right? So I think we have to play with the valuation there. There are many product companies today in Bharat that I think are building very good, globally competitive IP. These are in the B2B space. They are not building globally competitive IP in the B2C space. Like we don't have a TikTok, right? But we do have very good banking and finance tech kind of companies, very good technology platforms being built, being used throughout the world. You can look at the kind of clients that these companies have, and individually evaluate the risk reward with the valuation and promoter quality and things like that. So I think there are enough opportunities here, but one has to study the company.
Right. So, Swarnashish, anything you want to ask or add to the ongoing discussion before we part ways for today?
No, I just want to say one thing. The idea of studying 5,000 companies was really a eye opener for us. It shows what kind of hard work he's doing. And actually, last week I was in his home, so and I saw what kind of work he is doing and what kind of motivation that he is bringing to us. And we should also work hard and keep studying companies. Thank you, Sai.
Yeah, thank you, Swarnashish bhai. It was great to meet you, and I hope all of us can work hard. And I absolutely love this field because it's a very collaborative and win-win kind of field. All of us can work hard, collaborate, and succeed together. So I hope all of us work hard and succeed together.
So true, Sahil. And I hope we did justice to your time and you enjoyed the session as well.
Yeah, thank you so much, Prince bhai.